Quick question. Is your paycheck still doing the heavy lifting, or did your investments quietly pass it without telling you? Most people miss the tipping point because it doesn't ping your banking app. It creeps. Early on, $300 gains feel like nothing against a $50,000 salary, so you ignore them. But there's a precise moment when the curve bends and your portfolio can generate more in a single year than you earn at your job. In this video, I'll show you how to spot that moment, why it's invisible at first, and the exact target that makes it real, so you stop judging progress month to month and start playing the long game. And yes, we'll start with that $300. So let's talk about the hidden trap. Why $300 feels like failure. If your portfolio made $300 this year, are you actually behind or right on schedule for a future $50,000 year? Early gains look like rounding errors next to a $50,000 paycheck. Your job deposits hit your account on schedule, cover rent, and buy groceries. Investments, meanwhile, toss you a few $100 and call it progress. That contrast creates a false signal. You start thinking the market isn't working, or that you picked the wrong funds, or that you're just not cut out for this. The truth is, you're comparing two different systems on the wrong scale. Your brain loves straight lines. You work 40 hours. You get paid. It's clean. Markets don't move that way. They're noisy. One month looks flat, the next month jumps, the next dips, and the dollar amounts are small at first. So you feel tempted to quit, pause contributions, or swing for home runs to speed it up. That's the trap. The comparison makes the small, normal gains look like failure when they're actually the foundation being poured. And according to the data, this early pattern is normal and expected. Think about years 1 through 3 when you're putting in $6,000 each year. You check your account after year 1 and see the market added roughly $300. By year 3, total market growth might land around $1,200 to $1,500. By year 5, maybe it's about $4,000. Those are real gains, but they feel tiny beside a $50,000 salary. That feeling is the scale mismatch at work. You're judging by present size, not by pace. The rate matters more than the headline dollar amount in these early chapters, and most of your portfolio's value at this stage comes from your own contributions, not the market. That's why the results feel small. Your savings are doing most of the lifting, while the compounding engine is still assembling. It's like planting bamboo. For a long time, nothing impressive breaks the surface. Underground, though, roots knit together and store energy. Then the shoots arrive fast. Your investments behave the same way. In the beginning, your contributions dominate the picture. The returns exist. They're just modest because the base is small. As the base grows, the same percentage gain throws off bigger and bigger dollars without you adding more hours. The slow-fast pattern is how compounding works, and the slow phase is not failure, it's setup. If 5 years of steady $6,000 deposits only show around $4,000 of growth, that's not a verdict on your strategy. That's the engine assembling itself. Reinvested dividends, automatic contributions, and time are bolting the parts together. You're building a machine that eventually runs on its own. So reframe the $300. It's not a failing grade. It's the ticket price. Those dollars prove the engine is on and idling. Keep feeding it. Focus on percentage gains and the growing base, and every turn gets stronger. The small numbers are the early signals that the system works the way it's supposed to, even if it doesn't feel rewarding yet. And once you accept that, the real question becomes where the curve actually bends and how to recognize it when there's no alert telling you it just happened. So where does that bend actually live? This is the quiet tipping point, the point where your portfolio's average annual gains outpace your paycheck. The tipping point isn't a date on a calendar, it's a math threshold. It's when the average annual gains from your portfolio surpass your annual salary. Anchor it to one job number. If you earn $50,000, the question becomes, how big does your portfolio need to be for a normal year to throw off at least $50,000 without you clocking extra hours? Using the long-term average of about 10% from the S&P 500, that points to roughly $500,000 invested to generate $50,000 in a typical year. That's the hinge where growth stops asking for your time and starts generating its own momentum. Here's the catch. Markets are lumpy. One hot year can make you think you've crossed over. One red year can make you think you're miles away. Neither snapshot tells the truth. You need a rule you can actually use. Aim for a portfolio that can produce your salary at a reasonable long-run return. If you're comfortable with a 10% expectation over decades, $50,000 a year points to about $500,000 invested. If you want a conservative withdrawal power closer to 4%, the target climbs to around $1.25 million. The number you pick depends on risk tolerance and time horizon, not last month's chart. Why is the moment invisible? There's no congratulations, no banking app alert, and no one letting you know you've arrived. Dividends drop in, get reinvested, and vanish into more shares. Appreciation stacks quietly, months blur. Meanwhile, your job pays after taxes, retirement contributions, healthcare premiums, childcare, commuting, and all the small costs of working. Your portfolio compounds before any of that. In that sense, market gains are pre-tax, friction-free money relative to a paycheck. A $4,200 monthly paycheck feels strong, but a 7% move on a $600,000 portfolio is $42,000 in a normal year, and it doesn't ask you for a commute. Take a quick story. Someone hits $500,000, opens the app in a flat month, shrugs, and goes back to work. A quarter later, the market has a standard uptick. No fanfare, no email, just a $40,000 to $60,000 lift on a year that wasn't even exceptional. That's the crossover experience. It hides inside average returns landing on a larger base. To avoid chasing the weather, define the climate. Set a dollar target for the tipping point instead of judging a single year's performance. Use a return band you believe in. Conservative planners choose 4% and accept a higher target in exchange for sleep. Moderate builders look at 6 to 8% and choose a middle ground. Aggressive investors might model 9 to 10% knowing results will swing. The target isn't about precision to the penny. It's about a clear threshold that signals your capital can carry your salary. With the threshold defined, the next step is understanding how the small, early gains stack into meaningful annual dollars without changing jobs. Let's shift into the phase that tests most investors. From linear to accelerating, the 5-year patience test. How do $300, $1,200, and $4,000 turn into $10,000 a year without you changing jobs? Let's break it down with a simple 5-year path. You put in $6,000 each year. In the early stretch, the base is small, so the market's percentage gains translate into small dollars. Year 1 might add around $300 in growth, which barely moves the needle next to your paycheck. Year 2 adds a bit more because you're earning returns on a slightly larger base. By year 3, you've stacked contributions and a few reinvested dividends, and the gains show up in the $1,200 to $1,500 range. None of this feels big, but it's building the base that future returns will multiply. Years 3 through 5 are the grind. This is where most people bail. Noise feels louder. You're making sacrifices, and the market throws you numbers that look small in absolute terms. It's tempting to think, why not use that $500 a month for something I can enjoy now? That's the moment many pause contributions or start tinkering right before the compounding begins to accelerate. By year 5, seeing roughly $4,000 of growth can feel underwhelming compared to a $50,000 salary. That mismatch tricks you into thinking the strategy isn't working. but the math is doing something very important. It's shifting the weight from your savings rate to your return rate. The base you've built starts to matter more than the energy you put in each month. Here's where the acceleration sneaks in. Gains begin to stack. A normal year can jump from $2,000 to $5,000 and then to $10,000 as the portfolio gets larger. You're not changing jobs, hustling extra hours, or picking lottery stocks. You've just raised the surface area for returns to land on. Think of your contributions as a staircase you climb one step at a time. Somewhere around this stretch, that staircase smooths into a ramp. Each step widens because the returns add to the base, and the next percentage move throws off more dollars. Research-backed thinking supports this pattern. Your contribution rate dominates early. Your return rate dominates later. Both matter, but at different times. Early on, attention should go to consistent deposits and low costs. Later, the same discipline helps your returns do the heavy lifting. A 10% move on $10,000 is $1,000. On $100,000, it's $10,000. That's the quiet flip from linear to accelerating growth. It's a transition phase, not a failure phase. Now the behavioral part. Resist fiddling. Asset hopping, timing attempts, or chasing hot tips can reset compounding and invite taxes and fees that eat the base you spent years building. The money that grows best is often the money you don't touch. Set your plan, automate, and let the reinvestment loop work, especially during this patience window. Here's the mini payoff. Your steadiness in years 1 through 5 sets up whether years 6 through 10 can start covering real bills, rent, vacations, car payments, using money already set aside, with no extra hours required. Keep stacking those steps until the ramp takes over. Next, you'll translate that accelerating engine into a concrete target that your portfolio can reliably pay each year. Let's turn that momentum into a target you can actually build toward. Designing the target, your portfolio as paycheck plan. If you wanted your portfolio to write you a $50,000 check each year, what exact number would you aim for? Stop chasing a yearly return like it's a report card. Swap it for a stable target, a portfolio size tied to the dollar income you want. Instead of asking, "Can I make $50,000 this year?" ask, "What portfolio size tends to produce $50,000 in a normal year?" That shift replaces hope with a number you can calculate and fund step by step. Pick that wrong target and you either wait years longer than necessary or stretch into assets that don't match your risk tolerance. Set it too low and you end up compensating with leverage, timing, or concentrated bets. Set it too high and you stall, thinking the goal is out of reach. The fix is to choose a return band that fits you and map it directly to your income goal. Here's a simple framework. Choose a target return band that matches your comfort level and horizon. Conservative planners use 4 to 5% and accept a larger target for more certainty. Moderate builders use 6 to 8% and accept some volatility. Aggressive investors model 9 to 10% knowing results will swing. Then translate your income goal to a portfolio number. For a $50,000 yearly paycheck, that's about $1.25 million at 4%, approximately $830,000 at 6%, around $625,000 at 8%, or close to $500,000 at 10%. The band you choose sets the destination, not your mood on a red or green day. Now add real-world buffers. Think in net terms, not gross headlines. Taxes reduce what you keep. Healthcare and insurance add fixed costs. A margin of safety gives you flexibility when markets cool off for a stretch. And remember the asymmetry. Salary shrinks after taxes, retirement contributions, commuting, childcare, and other work expenses, while portfolio growth compounds before any of that. If you want $50,000 in spendable income, aim higher than the bare calculation so you don't rely on perfect years. Net pay thinking beats gross pay guessing because it mirrors how your actual bills get paid. Then make the system do the heavy lifting. Automate contributions on a set schedule so deposits arrive whether the market is calm or loud. Reinvest all dividends so your base grows without extra effort. Use low-cost, diversified index funds, or ETFs, to keep fees from eroding progress. Rebalance periodically to maintain your risk mix and prevent one asset from quietly steering the whole ship. Lock in behavioral guardrails before the next downturn tests you. Pre-commit that you'll keep contributing and rebalance instead of selling in a panic. Write down the signals that would actually justify a change so you don't drift into a new style because of headlines. Avoid hopping strategies. Timing attempts, chasing hot tips, or frequent switches can reset compounding and invite taxes and fees that erode the base you spent years building. Set the number, build the system, and track progress against that paycheck target. Because the next challenge is recognizing when the math quietly flips in your favor. So how do you recognize the moment your capital quietly takes over? When your money clones you, spotting the quiet crossover. How do you know the crossover happened if it never feels like a big win day? The app doesn't flash confetti when your capital starts carrying more of the load than your labor. It's quiet, which is why you need hard signals, not vibes. The first one is simple. In a calendar year, your investment gains exceed what you contributed. If you put in $6,000 and the account grew by more than that without new hours from you, the balance is tilting. The second signal is stronger. Your rolling 3 to 5 year average gains line up with your salary. Not a lucky spike, an average. The third signal shows up in your gut. The daily or monthly swings in your portfolio feel larger than your annual raise at work. Taken together, these point to a practical reality from the research. You've created an alternate version of yourself that works in the background. No sick days, no burnout, no meetings. Market noise tries to blur those signals. A hot year can fool you into thinking the switch flipped. A red year can convince you you're not even close. Neither is the truth on its own. The larger your base, the more a normal percentage move throws off real dollars, even when the headline is boring. 1 year down doesn't erase the math of a bigger compounding engine. That's why you replace single-year snapshots with rolling averages. You want trend, not weather. And if your money rides broad markets like the S&P 500, that clone income benefits from compounding that roughly doubles about every 7 years at long-run rates, a cadence most salaries never match. Here's the method. Each quarter, log 3 numbers. Total new contributions, year to date, total return in dollars, year to date, and the average annual gain over the last 36 to 60 months. If returns beat contributions, flag it. If that rolling average sits near your salary, star it. If your portfolio's normal fluctuations overshadow your job's raise, underline it. 2 out of 3 signals sustained over time is a practical confirmation that growth has shifted from labor-led to capital-led. That's when your second version is clearly on the clock, compounding whether you're at work, asleep, or on vacation. Look at it through lifestyle. When routine portfolio growth covers a real bill, rent, childcare, travel, you didn't trade Saturday for it. No commute, no late emails. That money grows before lifestyle costs, while your paycheck shrinks after taxes and work expenses. $1 of market gain isn't carved up by payroll deductions before it compounds again. It stays in the engine, which is why it accelerates your base faster than $1 earned at your desk. This is also a preview of the next milestone, reaching a level where the 4% rule can fund your lifestyle from capital alone. This is the mindset shift. Your second version, capital, works 24/7. You manage the Compare your current balance to your portfolio as paycheck target, then adjust the savings rate or the asset mix if you're off pace. Don't change the mission. Keep deposits automated, keep dividends reinvested, and let the rolling averages do the talking. Naming the crossover locks in patience and sets you up for the real quiet phase where your capital steadily outworks you. The tipping point isn't loud. Your capital starts outworking you after you've aimed at the right number long enough. It shows up when a normal year from your portfolio quietly matches or beats your paycheck, without extra hours or a calendar alert. That's your cue to act with intention. Set your income target, convert it to a portfolio number, automate contributions, and track rolling progress instead of single months. Keep deposits steady, reinvest dividends, and review against your target on a schedule. Drop your number and your timeline in the comments. Next video, we'll build a simple, low-cost portfolio designed to carry that paycheck.